Greetings. All right, it's February 12th. Thanks for joining, everybody. We're going to talk about taxes. What?
Woo!
Oh, woohoo! This is actually part two of a part one video I did last year, November, where I was talking about what the heck was that? Oh, why an LLC may not need to file a tax return and actually gave you legal citations. So that was a few months ago. And part two is going to be about the assessment, and I'll share a couple of true stories with y'all so you can see how this factors into maybe decision making or understanding what you're dealing with. So understanding about the assessment process is a very useful tool to, first of all, avoid the fear in dealing with tax authorities, state and federal, by the way. Once you understand the assessment process, it gets kind of fun because you know what's funny is the secret is that the tax collectors never make assessments. They just go on what you say. And unless it looks wacky, then they want to audit you. But anyways, we'll get into that. So thanks for joining, everybody. Let me just talk about aceofcoins.com. It's a great way to connect with me. I think there's a way to get my email there. I don't know if Jim set that up yet. But aceofcoins.com, you can schedule calls with me. And then aceofcoins.club, you'll see lots of changes there for new content. I did a class a week ago, and I think it's a very unpopular subject, or maybe people are afraid to talk about it. It's like that conversation where you know that your parents don't have a clue about money or something, but they have some savings and whatever and some property that you know is going to be part of the estate when they die. But who wants to talk with his mom and dad about, hey, mom, when you're dead, what do you want to do with the car? Nobody wants to talk like that. And so I think that was kind of the what was going on with that class. Now, some of you came, Elaine was there. She has some really good questions, by the way. And so I was talking about postnuptial agreements. And as what I do, I talk about financial risk. And so a postnuptial agreement is not a way to exploit the wife. That's not what I'm talking about. In that subject, I was talking about how to use a postnuptial agreement for asset protection, and the biggest risk being the court, among other things. And also what I mentioned in that, if you want to check it out, I mean, we just put it up there for like 97 bucks if you want to go watch this. What I was explaining in there, if you want to watch, is how to set aside a small amount of money periodically to create new cash flow within the marital community in the form of an annuity. There's several types of annuities that I recommend there, and there's lots of uses for these tools. You have to watch the video to know more, but I'll bet you anything you never thought I'd talk about annuities with a postnuptial agreement, and you probably never imagined that I would talk about trust formations through a postnuptial agreement. But y'all missed it. But the recording is there. I'm trying to get y'all to sign up. All right, so that's aceofcoins.club, and you'll see we got some more content, all kinds of new stuff we're putting up there. So, anyways, today's part two, following up from when I talked about why an LLC may not need to file a tax return. You guys can interject, you know.
I
Okay.
just want to say that class was great, and it's something that you have to think about because it's real, and you can protect yourself and you can protect your family.
And you can actually create cash flow for yourself if you do what I'm showing you. You can actually create income that would actually replace your need for Social Security. I mean, it's amazing. There's all kinds of cool things you can do. But imagine if, uh, hopefully this never happens to you, but if you wanted to separate, right? The husband and wife wants to maybe one day separate. There's already built into the arrangement, the postnuptial, there's already what we would call alimony and child support and all these things, and even care, like health care is already factored into the way I structured it. So it's almost like an asset unto itself, or a tool for that, for managing that. So hey, Karen, would you want
Hi.
to? Yeah.
Yeah, I just want to clarify. So the class wasn't necessarily focused on if a couple needed to split. You taught in the class about using this cash flow idea with the annuity to possibly even replace the Social Security.
Sure.
Okay,
But
that's
it's
cool.
not the postnuptial is not about preparing for divorce. It's preparing to stay married for the rest of your life. It's really
Okay.
for that. It's really to discourage divorce and be pragmatic about the use of property and money in the marital relationship. So it's to preserve the marriage. Heck yeah.
Got
And
it.
yeah, not trying to take advantage. Although I did admit in the whole thing, I did admit that it was biased in the favor of the man. So but it can be recalibrated. I had I had a version of this I gave to a client and he sent it back and he goes, "Wow, it seems really unfair for her." I said, "I know, but I'll fix it." So I changed it.
My daughter
Anyways,
got married a year and a half ago, so yeah.
it's a good tool. I mean, it's also it brings into the relationship the awareness, cognizance of money and future use of money and
Mhm.
letting money work for you in such a low risk way. So I hope.
Yeah. Yeah, they're pretty smart with money, so they
All
just would
right.
be turned off if there was anything about divorce. But I know how to frame it now.
Well, if you want a
So
real buzzkill to party, mention postnuptial and
yeah.
you'll be so
Right.
popular.
Great.
All right, so part two, and I'll tell you two stories because it's kind of interesting. So, and I love to do cases where I get bragging rights. So this is one of those things. So, and I'm one of them I'm going to talk about. Not ready yet, but the other one, yeah, ready. So the first one is a state case, state of Ohio, in 21 or 22. We asked, he got this guy, so he filed a tax return and he owed 20 grand. So then he got a bill. He didn't pay. And so the state sent him a bill saying, "Hey, where's the money?" And then he contacted me. He goes, "What do I do?" I said, "Well, let's act as if you gave me the money to pay them because you're such a good taxpayer, although you didn't. But let's just say you did. And I will represent you and I will contact him and we'll set up a meeting and I'll tell him, as your agent fiduciary, I'm holding the money right here and I'm going to give it to you, state tax collectors. But first, it's my job to make sure that he actually owes it. So I need to see the bill." And so the language for that is the assessment. And so there's a statute, there's a law in that state that requires the State Department of Revenue to make an assessment establishing the tax liability. What the heck is that? An assessment would be like, okay, I love to use this analogy. So if I go to a restaurant and then we have a nice meal, and then the waitress comes over and says, that'll be just verbally, she says, that'll be $138. And so I say, well, that's so nice. And the meal was worth it. Certainly. Where's can I see the itemization of what we ordered? She'll say, no, it's somewhere, but you just take my word for it. It's $138. And so, of course, you wouldn't do that, right? I mean, most of us wouldn't do that. Well, when it comes to interaction with government, it's even more important because when there's an assessment, there's a reason for the price. This is the whole idea, okay? The assessment is the reason for the amount of money that you're supposed to owe. There has to be a reason. What's the reason? Well, you were involved in a particular taxable activity, which is defined in the law, saying if you're doing that and you get money for that, then you owe a percent tax on that. That's where the assessment comes from. So only an officer, an employee of the government can who actually has the authority to make the assessment. You can't make the assessment. And I know the language out there that's floating around is everyone assesses himself. Okay, fine. But that's not what the way the law reads. The law says, in the end, a government officer must assess the tax because he has to be. That's how it has to work. So somebody assesses the tax, describing the type, kind, or class of tax, what tax period it was, how much it is, what the rate is, what the law is imposing the rate, what statute describes the taxable activity, this sort of thing, right? And then there's an officer who provides this, and let's call it like it's an affidavit, but it's a certificate. And so the government just doesn't give it to you. The government has it and then sends you a bill and says, we have it. Here's the bill. Now, if you want, you can ask for a copy of it and they'll give it to you. They're supposed to, anyways, if it exists. What's the big deal to have an officer come up with the tabulation of how much money you owe in a tax? What's the big deal? So, anyway, so I said, we get him into a meeting. And by the way, we sent this letter in asking for the assessment to the state of Ohio. And it took anybody want to guess how long it took the state of Ohio to respond to the question of, can I see the bill, please? And it was a polite letter. Anybody want to take a guess at how long it took them?
Everyone's guessing 6 months.
Two
A year.
years.
2 years?
Wow, you got it right on. It was 2 years to the month.
Wow.
Yeah. So
You could be earning interest in all
I,
that.
thank you. Right. Exactly. This is why I tell you guys. See, Elaine knows. See, so who's better to have the money in his hand? The government, look what they're doing with it. Or you?
Yeah.
Yeah, because you could have doubled your money if you're like a real estate investor or something. You could have doubled that money. And so basically you didn't pay it's free if you want to look at it that way. So yeah, you're right. But so yeah, 2 years. And so I kind of ignored that. Fine. You guys want to wait 2 years? Okay, fine. I'm still here. I'm still waiting. And so we did it again. We said, yeah, what I said 2 years ago, yeah, I'm still waiting for that. Okay. So they said, oh, we'll have to set up a hearing. So we go to a hearing. Now, a hearing means it's kind of like, traffic court. So it's on the phone and there's a hearing officer, and this is the judge, administrative law judge. And you would think there's a neutral judge, right? And there should be a representative from the state. Nope. The hearing officer was also representing the state and he was the hearing officer, so. Now this was a 9-minute hearing, by the way. We recorded it. We have an audio of this. So I asked him, we went round and around in circles, and I said, okay, so I have the money here. I just want to see the assessment. He goes, well, your client filed a tax return on this date. He starts reading all this pedantic information. And I said, I understand all that. We admit to all these things. What I'm asking you is for the actual assessment that you're required to perform as per state statutes. And he says, well, the return was filed. He goes back to the return. And I said, okay, let me ask you this. So when was the tax liability established? Was it before he filed the tax return or after? And I got no answer. Like he couldn't say anything
Mm.
except to restart back to again. Well, a long time ago there was a tax return filed. It was no answer. So I said, okay, look, I don't want to ruin your day. Let me just do this. If you could please make your findings and we'll go ahead and, we'll follow the process. We'll appeal it or whatever. So he seemed kind of relieved. So we waited and waited and we got our findings, and which gave rise to an appeal. And so we go into the appeal and we got everything briefed up and everything. And then we get a notice of reassessment. Once the appeal's docketed, we get a notice of reassessment. You can't do that. It's actually illegal. You cannot create a new assessment once your assessment is under appeal. Now, we were
Mm.
we were asking for the assessment. We were not challenging the assessment
Mm-mm.
or asking that it be reassessed
Mm-mm.
because there wasn't one.
You're just asking for it.
So, right. So the commissioner for the Department of Revenue wrote a brief back saying, your petition, no, the petitioner sought the reassessment of a tax and blah, blah, blah for like, 5 pages of
Oh.
blah, 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 whatever. And it was nonsense. And so we filed the thing. So what they did is there's two things going on here. So what they did is the DOR sent the letter saying we reassessed it, we added 5 grand or something. But then they had a column adding up the numbers that came to the new number, and it was arithmetically incorrect. Like if you got a calculator out and add it all up, it was off by like several $1,000s. Like if you're gonna fabricate a record, at least you can add some numbers together and make it look halfway like for real. But you cannot reassess a debt once it's under appeal. Anyway, so we sent him a letter and said basically it's BS and we're ignoring that. We're just going to wait for you to make a ruling on the appeal. And then so we sent a brief in, and we sent a brief in a month early, which actually turned out to be 2 days ago, like actually 4 days ago. And our brief crossed in the mail with their brief, which was a month early. And their brief said, you're just a tax protester, pay the money. Shut up. That's basically what it said. So this is where we are now. So we're saying, hey, wait a minute, you didn't even look at what we just sent you. You're a month early in making your determination. We still had another month to file the brief, in which it came in the mail the same time you sent us yours. So you need to reconsider what we're just sending you. So now we're waiting on that part of it. But what they're trying to do is they're trying to create, and this is my opinion, I think this is what's going on. They know that if we appeal it, the appeals court's going to say, well, heck yeah, you guys have to have an assessment. And these people asked you for it. And so they don't want that to be on the public record in the court system because that's where it's headed. Because imagine if other people see this and some lawyers see this who want to make a name for themselves, and they find out that the Department of Revenue is not making assessments. Can you imagine?
Mm.
Let's say you can go back 3 years for everybody in the state of Ohio who paid in money for taxes to get their money back. You would have a valid claim for refund, right? If there was never an assessment. Ooh, that's ugly. So here's what they did. They contrived this scheme to give the final conclusion a month early and not consider our brief and create a procedural error so that now the only appealable issue is the procedural error and not the failure to assess the tax. They're very clever.
Mhm.
It ain't going away. It's coming. But I'm just saying this demonstrates how powerful this understanding is. That's why I'm going to share it with you guys
Well, it's
and ladies.
corrupt.
It is corrupt, yes. And also it's rife with incompetence. And I was trying to be nice to the person, I'm trying to educate him and say, look, here's how this works and all this, because he's doing his job his whole career and is just, stamping things with a gavel and he's not even thinking. And then along comes a person with no lawyer and, makes this argument. So anyways, this tells you how important it is, okay? How they're handling it. It's like a hot potato. They don't want to handle it. They wish we'd go away. You would think they'd make a deal with us quickly, you know? So anyways, now the other case is a federal one, which probably appeals to many of you. There's a federal one. This is a few years ago. You probably heard this one already. But the federal one, first my clients went through an audit, and in this case, I saw that the IRS is going to be abusive. I've seen so many audits and things like that. And so they were kind of mean to my clients. They didn't like how I had my clients answering their questions on the audit. So I told my clients, I said, well, you know what they're probably going to do? We've concluded the audit, but probably what's going to happen is they're going to refer this to the Department of Justice, and they're going to call you into federal court and say that you're going to say you use the Fifth Amendment, and they're going to say that you refuse to answer their questions. So I said, when you go to the one meeting, I give the IRS, I say you can only have one meeting with my client. They go to the meeting. I said, this time, get a court reporting service, and so we found a court reporting service. Court reporting. This is where they sit there and they do the typing.
Mhm.
We got one of those guys. He goes in there at the audit and he's taking the transcript of everything that's being said from the beginning to the end. So the audit's finished. Then about a month or two later, sure enough, the DOJ sends a summons from federal court. Sure enough, just like clockwork. And so I read the complaint to the district court judge, and sure enough, is exactly what I said is going to happen. I said, they're going to say that you use the Fifth Amendment, which I told my clients never do that, which they never did. It was never anywhere in the transcript. And I said, let's answer the questions. And we answered all the questions. We already, I mean, I'm sure if you know me, I'm not going to give an answer a certain way. So, I mean, that's what they were complaining about. So they lied to the judge about this. So we filed a motion to dismiss. We said, even if that's all true, you still don't have cause. And we made the argument, and then we gave a copy of the transcript. Within 30 days, the DOJ withdrew its case with a two-line statement. So that wasn't good enough, though. They withdrew the case, so we won that case. So that was the end of the audit finally. Thanks for the transcript. So then about 3 months later, the IRS, the Department of Justice, sues my client for the total amount of money that the IRS wanted. So instead of going to the audit to try to figure out how much money, the IRS just said, well, you owe $600,000, and they sued my client for it. So now there's a dollar amount. So here's what they did is put their head on the chopping block. The IRS put its head on the chopping block by saying you owe 100 or $600,000. And when I read the pleading, throughout the pleading, it was just rife with the assessed tax is this, and the tax that we assessed, and the assessment was this, and the assess. It must have been 47 times in like 10 pages or something. So based on all that, we started a communication after we went through all the beginnings of the federal court, all the formalities of getting into the proceeding. After a few months, we start scheduling a deposition. That's the first thing we did. Let's have a deposition. And we want to cross-examine the revenue officer who made the assessment that you referred to in the pleading 47 times. Now they can't argue with it because you said there's an assessment, and a person at the IRS has to make the assessment. You can't go to somebody out at the park or some student at the university. No, it has to be somebody that works for the IRS. Right? So they try to play this game back and forth, and they try to trick my clients into like missing the deposition date. I mean, they tried all kinds of tricks to like side rail the depo, and my clients would say, hey, they're doing this now. Hey, they're doing this now, calling me and stuff. And I would say, Don't do anything. We gave him the notice. The time is coming up. And here's what I told him. I said, my bet is they're going to withdraw the case before the deposition because they don't have a revenue officer that did an assessment. They're lying. The day before, they withdrew the case because they don't have the revenue officer, nor do they have an assessment. Now, there are other cases where that didn't happen. I'm just saying but this goes again to show you that it's so important to have the assessment. So I did this part here, and let me do a screen share because you're going to see in the video the references. I want you guys to follow along. You can just go check it out yourself. Here, this is part 2. As you can see. So here's in the red font is kind of like, see what I'm doing here, guys? I'm using the chat GPT, okay? I want you to try it. You can do this yourself. So it goes through this whole thing about, yeah, the assessment, this and that. And section 1 of the Title 26, every CPA is going to cite that too. And then all these other things.
It's interesting that it says the liability exists by operation of law and not by assessment. What did you make of that?
Yes. Yeah. That's what I mean. You have to go by on the statute, So when a return is required, so how do we know a return is required? When a return is filed.
Yeah.
That's what I've concluded after like tens of thousands of cases. I have to tell you, the only thing I can figure out is there is no statute that establishes the obligation to file a tax return for an individual. So this section says when a return is required, whatever that is, the person who does that must pay the tax without assessment or notice and demand. Okay, now you're thinking, wait a minute, John just said something different. Nah, not really. Because as we get into it, you'll find out, look at 6011 Taxpayers Act of Self-Assessing. And then the IRS says, okay, your self-assessment is the assessment. And this is not true, but we'll go on. And then here's the assessment is the internal accounting. It's a formality saying, okay, this is our records. We're going to go by this, and then we're going to move on. So that's what it looks like. And here's the courts. The taxes due and owing from the date the return was required to be filed. Again, that's, when is that? That'll never be answered because there isn't a date. But anyways, not from the date of the assessment. That's a very interesting thing to keep in mind. What the heck? You would think, now I've told people for years, there's not a tax liability until there's an assessment. And now here it's saying, no, there's a tax liability when the return was required to be filed. It doesn't say when the return was filed. It says when the return was required to be filed. How do we know when the return was required? We don't. There is no
April
statute
15th?
that tells.
Is it like that?
What?
Is it just April 15th?
That's what everybody believes.
Mm.
And there is no such legal duty.
Right.
But everybody believes that thanks to mass media, television. I mean, think about it like this. When was television became popular in homes in the 1940s, maybe? And that was just following the reorganization plan in 1935 or so. It's perfect timing to get everybody, educated and believing the same thing. So the assessment is essentially a bookkeeping notation. All right. So that's what, these Supreme Court holdings in 1935. 1954. Now, it's interesting to note the tax code was amended substantially in, I believe, 1939 and 1954. There were substantial amendments dramatically changing the tax code. So sometimes when you have a case citation that's this old, like 1935, it may have changed because there's been a 1954 revision, a 1986 revision, and maybe a 2001 revision substantially. So that may not even be relevant anymore. But anyways, so here's what, you got this video here, so you can slow this down and see later. I don't want to just be pedantic and go through this, but this is how it flows, okay? This is so important. The taxpayer's first formal chance to contest the liability. So the purpose of the assessment, part of which is to allow the taxpayer to say, hey, is that right? I don't owe a tax on that one. But he can't say that until there's an assessment, right? And he's not going to go to the trouble of sending it to you. You have to ask for it. And they're supposed to then send it to you. If the IRS never asserts a deficiency, The liability is simply self-reported, and that's how mostly it goes. So, and there's your timelines. IRS assessment. So these are your statutes. Check it out. 6201, 6203. Check it out. In fact, if it's lengthy, because some of these are quite lengthy, you can actually take the section and run it through the AI and ask specific questions about that. So, and then I put my other, so the AI is summarizing. The liability arises before filing. Interesting. I've always said the opposite, but hey, I'm not going to argue with the case law because the code itself imposes the tax when taxable income exists. Filing the return reports the liability. Assessment later records it. Okay. So the opportunity to challenge arises with pre-assessment in tax court after notice of deficiency. Notice of deficiency allows you to go to tax court. Tax court is not about challenging that you're not a taxpayer. Tax court is only there to figure out how much you owe, and you're going to owe something. If there's a mistake, an error, then that's what tax court is for, to fix that. And then post payment through the refund process. So is the assessment of a tax, this is what I asked, an official function of the tax collector? In the case of the Internal Revenue Service, if yes, how can the taxpayer perform that function? So yeah, of course it now. So the AI is telling me, yes, of course, that you have to have an officer of the government make the assessment. So even though they promote it in the news, it's a system of self-assessment. The law itself says no, the final word is with the government. Of course it should be. The secretary is authorized and required to make the inquiries, determinations, and assessments of all taxes. Huh? The secretary, and he delegates that, the secretary is authorized and required to make all the assessments of all taxes that are imposed by Title 26. Okay, then. So there is no such thing as self-assessment. That's BS. The government must assess the tax. The assessment shall be made by recording the liability of the taxpayer in the office in accordance with the rules. So they have it. Now, here's a regulation. This is more information. So if you see a statute, there's going to be usually an implementing regulation that gives you more detail about so the Congress writes this, and the agency imposing the statute writes this regulation to carry out the mandate from Congress. That's how it works. That's why it's numbered in such a weird way. It's 26 Code of Federal Regulations, and that's how they number them all, I see. But 6203 is the assessment. It's made by an assessment officer, shall be made by an assessment officer, and it tells you he has to sign the summary record of assessment. He has to include supporting records, right? It has to be complete so that you can object to something.
Yeah, and it has to say who is the taxpayer, what is the liability assessed, meaning like what is the taxable activity, what's the taxable period, and what's the amount of the assessment, which would
And how much? Yeah. Now, in my
tax
opinion, here's the most important part. The character of the liability.
that.
Again, it's the taxable activity. What was I doing to incur a tax liability? Was I drilling for oil? Was I manufacturing pistols and revolvers? Was I, making am I fabricating a hazardous material, making armaments, bombs, these are taxable activities. So an assessment is an official act of the government. The taxpayer doesn't say it, self-assessment. All right, Congress
Does that
designed
mean working at Starbucks is not taxable?
Okay, that's a good question. So what you can find in doing your own research, and I'll save you the time. I've done it, been there, spent literally probably months figuring this question out, like Elaine just asked. So people in the private sector that are not working for the United States or a state and they're earning income wages, let's call it, these are not taxable wages. The only people earning taxable income and wages are employees of the United States, such as your congressman. But you're never going to win that argument. That's just how the system works. Just like with wages, most people, I mean, in the private sector, a wage is a very special term, okay? And a wage basically means you're working for the government, so the money you're getting paid is subject to taxation. If I'm working at Starbucks, my wages are not taxable wages, but I'm signing a voluntary withholding agreement as if they were, and everything goes from there. Yeah, and no one will keep you on the job, even though you've been hired. The employer thinks that signing a W-4 is your term of employment.
Yep.
It's not. It's a tax document. Your term of employment is, yes, you have the job. The guy telling you, right? So Self-assessment is just kind of like, rhetoric, people just talking. Our system of taxation is based on voluntary assessment, not on distraint. Well, it's all distraint. But anyways, that's 1960. It's all distraint. Ultimately, they'll just take it if you don't pay. So,
Could you repeat that? It's all what? Distrain? What's that?
our system of taxation is based upon voluntary assessment and payment, not upon distraint. Like a sales tax, I guess, is on distraint. Like
Can you explain distraint?
that would be
Not a
like
gun
forcing
to
someone
your
to pay.
head.
Huh?
Not a gun to your head, correct?
Yeah, kind of not like
There
that,
you
but like
go.
you can't buy the product from the grocery store that has sales tax unless you pay the sales tax. If you refuse to pay the sales tax, that's called shoplifting. So that's distraint, right? So as you
Strain is
understand,
force, correct?
yeah, right,
It's
distraint,
force. The government is forcing you to do this. Do they have the authority to make you do that? And
compelling it,
that's
yeah,
what
in
you
some
state.
one way or another. Not literally threatening you with violence, but yeah, that's the idea, distraint,
You,
force. So they get people to say, "Well, I'm going to do the right thing and I'm going to file a return because my Uncle Bob said he filed his return." That's how it works.
Hmm.
That's okay. I'm not going to complain. It's just how it goes. So, anyways, you can challenge an assessment, okay? Before an assessment, if the IRS proposes, have you ever gotten a letter that says proposed assessment? Slow down and read it again. Proposed assessment. It'll sometimes say, "This is not an assessment. Don't pay the bill. We're just proposing that this is an assessment. What do you think?" What do you think about what we just said? That's what it's saying, proposed assessment. And if you don't respond or something, or if you dispute it, they'll send you a deficiency notice. This is your ticket to tax court. You have 90 days in which to file one. So that you're going to tax court to get maybe a neutral party to see what there's a mistake, there's an oversight. All right. So after an assessment, before an assessment, there's 621213 tax court. That's your 90-day letter, notice of deficiency. After assessment, if the taxpayer pays and believes the assessment is erroneous, he can file a claim for a refund. Now, here's what's interesting. Let's say you think the assessment is wrong. This is where so many people get it wrong. Let's say you think the bill is wrong, right? Do you just go to the court and tell the judge, "Hey, judge, here's why it's wrong." And then you think the IRS is going to say, "Oh, you know what? We'll fix it." No, 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 you can't do that. But you know why? The judge will say, "I don't have jurisdiction." Huh? How would he not have jurisdiction? Watch this. After the assessment, if the taxpayer pays and believes the assessment is erroneous, he may file a claim for a refund under this statute. That gives the district court jurisdiction. If the taxpayer pays. So if the bill is like $10,000 and you disagree with it, you have to pay the $10,000 and then you can get the court to hear you. If you don't pay the tax first, the court cannot hear you. So you pay first and then get permission to get the money back later. That's our system. That's why people don't like it. And that's why ours has a bad reputation. But there's a level of efficiency that has to be upheld. I mean, otherwise it would cost more in many cases to than actually collecting the tax. So anyways, we understand. We do our self-reporting, we file a 1040, and then we can dispute after the fact and so forth. So who performs the assessment? Really, it's the IRS through the officers under these sections and so forth. All right. So I'll try to restate your response. So I'm trying to talk to the AI and I'm restating what it told me. Quoting, "The taxpayer can challenge the assessment made by an assessment in several different ways." It says, yeah, that's correct. So the taxpayer can challenge the assessment by first, before the assessment, through the 90-day letter, after an assessment, pay and go to the court, or after an assessment, before or during collection. You can actually do that. So, like, for example, if the IRS is collecting against you, you're already in the collection stages, and you can file a document with the IRS that says, I'm making an offer in compromise based on doubt as to liability. You can do that. That's what it's talking about here. These are new provisions, by the way. This is the result of severe abuse by the IRS over the years. And in 97, there was the Taxpayer Restructuring Reform Act that brought in these new statutes that gave people more remedies, and it created like two more layers of bureaucracy, but it's actually functional. It actually works pretty well. So the taxpayer cannot perform the assessment. See, this is the truth. When they say self-assessment and we get into this, it is only an official IRS act. So I asked it, once the IRS makes an assessment under this legal duty here, its own regulation, how is the taxpayer provided with notice of the assessment? So notice once an assessment is entered, the next step is a notice and demand for payment. So you'll get a bill. That's why I tell people, file your tax return and wait for the bill. Don't pay. It's like Elaine was saying, you could use the money better than they can. You can do something with the money. By the time you end up paying them like 2, 3 or 5 years later, you probably doubled your money. If you can, there's possible ways of doing that. So where it's not otherwise provided by law, the secretary, as soon as practicable, within 60 days after making an assessment, give notice stating the amount, demanding payment. So that's your notice and demand. You guys got letters like this, like it says like, oh, here you go. It says CP 14. CP is old lingo our old dinosaur system was in the 70s. It's called computer paragraph. It's a computer paragraph letter. Yeah, CP, they're not very creative, but that's what, if you ever wanted to know, I'm a geek. I'll always remember stuff like this. So CP is computer paragraph. That's what it means. Yeah. So, and by the way, if you look at the computer paragraph letters that are in the repertoire of the IRS, this is why if I ask you if you're dealing with the IRS, if I ask you to send me the latest letter, if I see that number, I know exactly what's going on. You just show me that one number and I could tell you your entire case. That's how their system is. So the notice tells the taxpayer that an assessment has been made, entered, and states the amount. It summarizes it, though. It doesn't give the assessment. There's no requirement, mail a copy of the actual assessment. The law only requires notice, but you can ask for it. The regulation that implements 6203, this is okay. So when it says section 6203, the regulation that implements this statute is right here. See how this works? Congress makes this. Actually, Congress writes the law, they adopt the law, and then some people, there's a process by which it's parceled out into sections in Title 26. So there's a couple steps there. But once you have the statute, the agency must write its own regulations within the statute. The taxpayer shall be furnished upon request a copy of the record of assessment. I've asked for that so many times they never give it, or it's a fake BS document, doesn't even have anything. And I'll tell you a quick story too on that one.
Or it's the racks.
It's yeah, okay. So they have this pretty good system where they figured out, looking at the end result, if I'm in tax court, if I'm the DOJ's office and I'm in tax court, can I get by with a fake record that I can tell the judge that says this is just as good as an assessment, Your Honor? And they actually did that. They actually created a ruse that allows them to squeak through the rules of civil procedure and allow the district court judges to accept things. But there's a way around that. We can fight it. But anyways, it's just interesting how this thing plays out. But this goes to show you how important the assessment is. So this is the form that's being used for the certificate of assessment, Form 4340. Certificate of assessment, payment, and other specified matters. Or you can get a transcript of the account. It's kind of complicated. Courts hold that a properly certified 4340 is presumptive evidence of a valid assessment. So it's not the assessment, but it's presumptive evidence. That's what they're doing, the 4340, okay? Now, you can undo this little ruse they've got going. I'm not going to get into the details on that, but I want to underscore the importance of what an assessment is. And this is what is so if you understand that, okay? Like one of my clients the other day, he literally got an email message from the IRS. I don't know why he's talking to the IRS like that, but they had 4 questions for him. And so he calls me up and we're talking about this. And I said, the nerve, they think they can just send you an email and you're just going to answer them. They just want to get information from you. And it's not from the criminal investigation division. It's not from the auditor. It's just some agent who didn't identify his role or his title and said, hey, tell me this information. So I told him, respond back and tell them to send you a letter. That's it. Send me a letter in the mail. And when it comes in the mail, I'll tell him, just keep it in your records and don't respond. Because it's not an official process. It doesn't create a duty to answer. You got to remember, the IRS is the police. I mean, if you're just shopping at the mall and the cops come over and they'll polite to you and stuff and then say, hey, what did you eat for dinner last night? Where were you? What are you going to do? Tell them? It's the police. Sure, you don't have anything to hide, but why would you tell him that? Maybe he has some scheme cooking up, right? If a taxpayer wants to inspect the actual summary record, he can request it. Under, you have to go to the FOIA. Oh my gosh. You have to use the Freedom of Information Act. It's ridiculous. But anyways, this is our system. This is our system. And they'll give you a transcript. So
A transcript of the assessment
yeah, it's like,
or
why?
the evidence of the assessment,
Yeah, it's always like everything about the assessment, but not the assessment because
not
they
the
don't do
assessment.
assessments. The truth is, guys, as you know, the punchline of this whole presentation is they don't do assessments. So when and how the taxpayer can challenge. So you get all this stuff, right? Before the assessment, after, during, after you pay, all this stuff in a collection due process hearing. All right. You can go to the Court of Federal Claims, all these things, right? But each of these courts have specific allegations and requirements and conditions before the courts will take jurisdiction. So you really have to know what you're doing, not just because it's a court and I can file some papers and pay a fee. No, 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 no. You have to make sure there's jurisdiction. So there's no automatic right to cross-examine the assessment officer. So just because you got a copy of the assessment, it's not time for depositions. You have to be in the right forum. You have to be either in tax court or something, and or you have to have paid and then filed a petition in the district court. Then you can cross-examine the assessment. I like the case like I described to you earlier, where the IRS sues first, because now the burden of proof is on the IRS, and now I have a right to cross-examine all their claims and the allegations in the pleading. Thank you very much. So it goes on, prima facie proof. So they've got this scheme going where they don't have to give you the assessment, but they can give you a pretty good record of what the assessment said because the judge will let us, is how it goes.
Mhm.
All right, now we're getting towards the end here. So what if there were no assessment, there was not an assessment officer? This is important. What if there's no assessment officer and the records were fabricated? I use this term with software. That's really what they're doing today. And information provided by the taxpayer without the involvement of any assessment officer. So the Irish just gathered records and used software to create a fabricated record. So if there were no assessment officer and the assessment record was generated automatically by software, this is exactly what the IRS is doing. The legal question becomes whether that satisfies the statutory requirement for a valid assessment. So there's now, is this a valid assessment? And so we have all these, so here, this is again, the method of assessment. Were these criteria met? What are the rules? See, it says in accordance with the rules. What are the rules? Right here. That's the rules. When it says the rules in the statute, okay, that's the statute. It says with the rules, what are the rules? The regulation. You see how this works together? The assessment shall be. That means there's no exception. It must be done. Doesn't say maybe. It says shall by an
And it's signed by
assessment
them.
officer.
Mhm.
What?
And it's signed by them.
Yes, it must be certified by somebody, a revenue officer, because there has to be a human being that's subject to cross-examination is what it comes down to.
Exactly.
Which I demonstrated in that one case where I said, hey, can we talk to the assessment officer? We promise we'll be quick.
Mhm.
That alone won the case. So shall provide identification of the taxpayer, the character of the liability. We just talked about this, right? And the assessment officer must sign it
Mhm.
because he's liable for it. Think about it. It's money. Somebody's accountable. You better tell the truth. If you don't, we know who you are. It's like that always with money. When you have a
And
large accounting firm do their records for a publicly traded company, you have the accounting firm. Some person at the firm is designated as the person who's going to sign it. The whole statement. You might have like a 500-page accounting statement, and somebody's going to sign that.
do you
There's
find it
always
interesting, John, that the
what?
AI says that they're calling type of tax what the regulation is calling the character of the
Yeah, that is
liability
interesting. Yeah.
assessed?
And the reg is written
That's a
by
bit
the
different.
agency, the director of the Internal Revenue Service. Yeah, and the others by the Congress. So
Does the assessment officer have to have a delegation of authority?
of course, and there will be.
Yeah.
You'll find it. It's pretty easy to find that. Yeah, there will be. They all have to have a delegation from the secretary.
Well,
Yeah.
but when you get the letter, there is no delegation of authority when you get a letter telling you owe this, that, and the other from the IRS, right?
Yeah, they're not really going to, in the automated collection system, you're not going to have a delegation. What you're just going to have is letters generated from an automated system. I mean, but there is a chain of authority. I know this. I've done checks on this before, and it's in place. I mean, they've been doing this for years. There is a chain of authority in most cases. So, but they have to show it. The assessment officer must sign, the record must identify, and all this computerized assessment. So it's telling you since the 80s, nearly all assessments are computer generated through master file system. But legally, those entries are considered valid because an authorized assessment officer approves them. So in the end, somebody has to be responsible. And so you can look this up. I'm not sure if I remember doing, checking these, but I mean, they're probably good cases. Now, some of this, okay, so this is in the Federal Reporter Third. Fed Third is what we call it, Fed Third and Fed Third. So, and that was from 1993. So we're probably up to the Fed Fifth right now. But anyways, you can look that up. So the absence of visible assessment officer does not automatically render the assessment invalid, so long as the record can be traced to an authorized officer's electronic approval within the IRS's system. Okay, so it's kind of they can probably pick up the slack any way they want. There's all kinds of ways they can do it, but it was really interesting. I mean, you would think you got all this money and knowledge and expertise and professional background behind a DOJ claim that a person owes $600,000. It wasn't $6. Okay, it was over $500,000. And I just asked for the assessment officer. I just wanted to ask him a few questions, and that won the case. It's important all the way around.
Yeah, and it's
So,
really interesting your point that you should be able to cross-examine your accuser.
always,
Therefore,
that's due
this
process.
computer-generated thing,
Yep.
that doesn't satisfy that.
Yeah. The government would lack authority. What does that mean? If the government lacks authority for doing something, then the notice and demand can't be valid, which means if there's lack of authority, that means there's no jurisdiction. So if there's no assessment, there's lack of authority, no jurisdiction. That's when you have the jurisdictional issue, not because you claim to be what do you call it, living in Puerto Rico now. That doesn't remove you from the jurisdiction, or you sent some brilliant, protest letter to the IRS. Aha, I called them on it. Yeah, I'm out of the system now. It doesn't work that way. Any resulting lien or levy would be void. Now, these are very difficult to undo. There are ways of doing it. I'm not going to get into that, but for lack of jurisdiction. So the taxpayer could challenge the actions in the collections due process hearing. Now, most of the time when I do a collections due process hearing, and I see a lot, almost all of them I can challenge for, I can make the challenge that uh, the liability is invalid. I can make that challenge, but I'd rather not, because what's easier is if I say, I don't mind paying everything you want. I just don't have the money. That's much easier. That is much easier. And I can make your money disappear. I mean, that doesn't mean I'm going to take all your money. It means I can make it disappear. So, and legally, by the way. So, collection due process hearing, refund suit, you got to pay first, right? Quiet title, I don't know about that one. I don't know that I've been involved in any of those. Um, in practice, certified transcript, this is going to go by this. It's presumed correct. Now, you can rebut the presumption. There is a way to do this. Got to know what you're doing. Hope you're never in that situation, and so forth and so on. Right? I don't want to go too far, and but you guys get the idea. What if the claim made by the IRS, whether it's considered valid assessment or not, fails to identify the character of the tax? And I'll tell you the story regarding this. I probably have told you the story before, but if an IRS assessment or claim does not identify the character of the tax, it fails to specify the type of tax. Yes, there is such a thing. Income tax, there is no such thing as income tax. There's a type of income or income derived from a type of activity that's taxable. Yes. And the IRS has codes for every type of income. And to go back to what Elaine was asking, most people that are working today do not have the type of income that is subject for taxation. And I know that if you're listening to what I'm saying, you might be very angry right now if you believe me. And I am telling you the truth. The taxable period and statutory basis. So when it's legally defective because it doesn't comply with the statutory and regulatory requirements, then there's no jurisdiction. So it goes into that, um, all these things. So it's just kind of restating everything. So without telling you all this information, you're denied due process. You're denied access to the right to be heard because you can't dispute something you're not provided for with which you're not provided. Okay. So you can look at these cases and see how the courts treat it. If you can frame a case correctly as there not being a valid assessment, the judges will hear it. This is what you want to be reading. Assessment is so key. Anyways, let's see this. So I'll get to the story. I just want this on the video. Okay, so the story is this. Forgive me if you've heard this story before, but it's kind of interesting. My first case ever, my partner said back in Arizona in 1993, he said, John, we got this new client. He's a farmer. You got to go help him. I said, I don't know how to do that, Frank. He said, no, no, I'll help you. And so here's a plane ticket. I said, what? I got to go to Missouri in December? You know, so I go to Missouri in December and I stayed at this guy's house for a few days and we're trying to undo his situation. He stopped filing, stopped paying. He owned this farm for 35 years and the IRS, he was in bankruptcy court. He was just trying to fight him in all kinds of ways. It was a big mess when I got there. And they had taken all the cars and vehicles and equipment off his property. They were going to auction it off. And he built his house. I mean, this guy built his house with his own hands. He was living in it. You know, I'm thinking, wow, this is amazing. You know, this guy spent his life building this, and the IRS is going to take it because of some paperwork, you know. So I've, I didn't get anything done the first time except to figure out what kind of mess he was in, which I still didn't figure out. So I came back in January the second time, and then I started looking at all his records and things. I started getting a beat on it, and then I came back to Arizona and I thought, you know, let me pull. I think the only thing I could think of is let's go to the beginning. What the heck is he being taxed for? Carol, did you want to say something before I continue?
Can you finish your story? Because I have questions related to other
Oh,
things. So
yeah, okay.
why don't you finish?
I'll be fast. So I asked for his individual master file, and I asked for all the table of decoding all the codes, so I understand because they're supposed to tell you what the codes mean. So I decoded his master file, and I found the taxable activity, the 6203 character of the tax. It's actually in his records. That was the first time I ever saw that. And I
Really?
since then I haven't used it. Yeah, it was actually everybody has this, you guys. If you want to go look, you can ask. You can go see what you're being taxed for. You might get angry. I'd say probably may not want to do it. You might be angry. But this guy was a flower farmer. It was a seasonal business, a farm, and he was making the flowers for the Macy's Day Parade every year. His family's probably still doing it. So his taxable activity code was manufacturing pistols and revolvers.
Mm-hmm.
This is why you hear me say this all the time. Of course, he wasn't doing that. He didn't have a license for that. So, what's the remedy? Well, I went to read the statute. The statute said you need to report this for a violation of 7214. You can look it up, 7214, to the FBI. So I did. I wrote a letter to the FBI, a 1/2 page, and I said, he's having this property taken from him by an officer of the United States. And under the guise of being taxed for manufacturing pistols and revolvers, and his only business is growing flowers. He's a flower farmer. And it was about when I sent that letter in, I think it was probably first class mail. I just mailed it to the FBI, some office. I don't remember. Within a month, our fax machine just started firing off all this paper. You know, it's back in the day in the 90s with a curly paper, you know, come out of there on Saturday morning. Then the phone's ringing and he's pick up the phone. And you can hear him on the speakerphone. Frank, did you get my fax? And sure enough, it was like 47 releases of levy, 22 releases of lien. You know, they gave all his cars back. They brought everything back to the farm and never heard from them again. He got all his money, everything fixed, done. That was my first case. I was like, what the heck am I getting into here? What kind of mess is this?
I love that
So,
story. That's great.
yeah, that made it stick in my tiny brain, how important not only the assessment is, but the elements of the assessment, the character of the liability. It's important. All right, that's the end of my story. Carol,
Can you get those codes just through the IRS website?
you not the website, I don't think, but you can ask them. I don't think they like to publish it. I forget how we got it back in the day. There's a
Funny thing about that.
6203 manual or some 6201 manual or
And
something.
what's the actual term that you used?
It would be, oh gosh, I don't know the coding they were using, but it would be the taxable activity code is how they termed it.
Taxable activity code.
Yeah,
All right,
that's how
thank
they
you.
termed it. Yeah,
Okay.
Carol.
Wow, that's a great story.
Okay.
So I have a question about what you were talking about just a few minutes ago, kind of in the middle. So you were saying that you can, so come April 15th, let's say I file my return and I owe, let's say $10,000. I can just file the return without paying and then wait for the IRS to send me a proposed notice of deficiency.
Yes.
And then I would respond and ask them to please provide the assessment for this proposed notice of
Yes.
deficiency. So that those are the steps to go through.
Perfectly.
And I'd
Thank you
be,
for saying that because that's kind of like the end of everything. Yeah, that's what you can certainly do. File, don't pay, wait for the bill, ask for the proof of the bill, and go from there.
and can I do that for state as well? I'm in California.
I believe it works the same way or at least similar. You can check your state statutes. You can take 6203 in the reg, run it through your AI, and then tell the AI to go look at the regs, the statutes for your state and see it, ask the AI, is this similar process? That'll
Okay.
be your faster way to do it. Yeah.
Okay, perfect.
Yeah.
Thank you.
Yeah, good question.
John, can I
Yes,
ask you
certainly.
unrelated question?
Okay.
Is that okay? Okay, which annuity would you advise?
Annuity?
Yeah,
Okay, there's so many different annuity products. First of all, I'd look and see who's selling annuities, like New York Life or something. See who's selling them, but then the choice of annuity has a lot to do with your demographic, like your age and your interests. And like for example, if you're really good about brokering promissory notes and creating cash flow with paperwork and stuff, why would you mess with an annuity? Because you already have a really good cash flow system that you can set up to make it better than an annuity because you control your return. With an annuity, it's kind of fixed, sometimes pegged to the stock market. So the type of annuity you want, sometimes you want an annuity that may mature in 5 to 7 years, or you want maybe a flexible premium annuity that maybe if you miss a few payments, no big deal. It's still a good annuity. Then there's some more strict ones where if you miss a payment, your annuity's canceled, you know. So you'd have to go shop around as to what products. And then what I'd like to do is think of an annuity as creating cash flow for the future to offset unknown risks or uncertainties. So that's what you're really trying to do. It's kind of like insurance. That's how I look at it. Uh, so you're setting aside cash, making a little money on your cash, a little bit, and then you're going to get that money later and you can get tax deferment and all these sorts of things. But I would first start with the purpose for which I want the annuity. What am I trying to do? So in my example on the postnuptial agreement, what I'm trying to do there is have some flexibility. So there's two types of annuities. If you look at my video, you'll see two types of annuities. But there's one that's flexible and there's one that's a little more rigid. The one that's more a little rigid is for further out into the future. The more flexible one is closer. So now I've got like a nice uh, uh, flow of the use of the money if I need it in 7 years. I have no idea if I'm going to need it in 7 years or 14 years, right? So
right.
you could do like 1, 2, 3. You could do like a new annuity product every 1 or 2 years. So they kind of like rolling around, right? So by the time you're, 50, maybe you'll have 7 or 8 or 12 annuities running around, just it's a way to put cash somewhere and make a little money on it.
I see, I see.
Yeah.
Okay, thank you so much.
Yeah.
Thank
All
you.
right. So if you file a tax return to answer B Good's question, if you file a tax return and don't pay, and the IRS is not able to get the money, it's kind of like that dream situation where if you're caught speeding by the cops, but you make it into your driveway before he stops you, then you're free and clear. You don't have to pay the ticket. He has to leave you alone. No, that's not going to work, right? So if you if you file a tax return and you owe money and you don't pay, and the IRS does all these things to try to get the money and it cannot get the money, whatever amount it does not get from you, like forcibly by levies or whatever, or trying to scare you into a payment plan, whatever it does not get on the 10th year is expired. It's zero. So it takes 10 years though. But you have to file. If you don't file, there's a presumption of fraud, and that would vitiate that statute. All right. Carol, did you
Yeah,
have
so
any?
I have a follow-up question to what I just asked earlier. So I've been paying estimated taxes, so then I would also stop paying the estimated taxes as well?
Yeah, of course. Yeah,
Okay,
keep your money. Sure. Yeah, yeah,
okay.
yeah. Yeah. I'll give you an example. One gentleman, he was a real estate investor, millionaire kind of guy, and he owed the IRS like $150,000. And he got this attorney or a CPA or a CPA attorney type deal. He got the first thing the guy did was get him into a payment plan with automatic deductions from his bank account, like $1,500 a month. And so as I'm talking to him, I finally asked him, I said, why, why are you paying this now? He said, I don't know. My CPA said I have to do that. I said, well, did you file the return? No, we haven't filed the return yet. I said, you're already paying? He goes, well, you're going to owe that money anyways. I said, look, you got to wait for the bill. You don't walk into a restaurant and pay the bill before you eat. Wait for the bill. He says, yeah, that makes sense. But. And so after I spoke to him a while, he finally realized he's wasting his money because this guy's an investor. So I said, look, you already have the means to make money on your money. Why would you try to $1,500 a month is how much per year? That's the what, 17, $18,000 or something like that? What could you do with $20,000? He goes, oh, I could do a lot. I said, could you double it in a year? He goes, oh, easily. A guy like that. So I said, wouldn't it make sense if you make them fight you and go through the whole procedure? Well, it's going to take 2 to 3 years in the earliest, while you're over there making money on your money that they don't have and it's legal to do that. Why wouldn't you do that? And I hear this like total silence because his brain is like thinking about this. Yeah. And he goes, that's a good idea. you know, he goes, what do I do? I said, well, the bank doesn't honor, changing the direct thing. So just close your account, open it. We had to do that. So we did that. We told the CPA, what we're doing, and he quit because he was so scared. But it makes way better sense to make the IRS come and chase you for the money. It's legal. You're not going to go to jail. Just don't lie to them.
John, maybe I missed something, but if you file that return, aren't you self-assessing that amount that's on that return?
That's the whole idea. It's a self-assessment, but ultimately the government must make has the final word on what the assessment is. The government has to do it, but they're going to base their records on what you say, unless it looks really wacky, because you're singing our penalty of perjury. But yeah, so filing the return is creating the obligation. That's what's happening. If you never filed the return.
No, I understand that. I'm in agreement with that, but you told her that you basically self-assess, don't give them any money, and then fight it. But you've already self-assessed to a number, correct? Aren't you committing to that number when
No, of course, unless you're wrong, sure. Yeah, exactly. You are. Especially like Eric's asking here. He's saying, well, what about all the penalties? Yeah, you can have penalties too and late payments if you play this game. But so that's what I tell my clients is. So I tell them, does it make sense? Are you able to run the clock on the IRS so that the IRS cannot take your money in the meantime?
So you're just saying to use the money, you can make the money. You're just saying, forget the penalties, interest, everything else. You're going to make more money by holding on to it yourself. Okay.
And provided
okay. All right. I understand what you're saying. I thought you were saying that you had a way after you have assessed, after you have filed, to get out of the liability, and you're not saying that at all.
You can do that. You can say, I want to see the assessment, and then you can challenge it. You have a legal procedure to follow.
Well, won't they just hand you your return? Let me see the assessment. They'll just hand you the piece of paper you sent in.
Well, I just explained, the IRS would come up with a certificate of assessment.
Okay.
If it
so
did,
it's additional paperwork that they're going to have to come up with, is what you're saying.
Okay. They can't just rely on your tax return. They do, but if you challenge them on it, they're going to have to produce the assessment. And you're going to have to know how to go to the court system to do it, which I don't recommend. I know how to do it, but I don't want to do it. Sure. I would just rather run the clock on them. And so I caution you guys on this. Running the clock on the IRS, you can certainly do that. Just be uncollectible.
Okay.
Be uncollectible. So even if you can do this, even if you have wages, just understand, if you have wages and you're filing returns and you owe the IRS a lot of money, it should be a lot of money. Your risk is 10% of your wages. So that's a heck of a deal. Why would you try to make a deal with the IRS when if you just don't pay them, but you file and you're uncollectible except for your wages, they're going to take 10% of your wages. because you're filing. If you're not filing, they'll take all your wages. But I'm just saying, if you're filing, you're going to expire the debt, and your exposure is only 10% of your wages. That's probably less than you'd be paying them voluntarily.
You're identifying a lower cost option.
Yeah.
I understand what you're saying. Is
Yeah. You don't,
use your
why
money
argue
to
with
your
them?
advantage, and
Yeah, life
understand
is
what you're
short.
saying.
Yeah, don't argue with a piece of paper.
But
Life is short.
the fact that they're screwing the American people does not get addressed. Correct? I mean,
Well,
what you're
people are
saying.
scared. I'm
Oh, I
not scared of them.
understand. Trust me,
Yeah,
I've been in this game for 30 years. I understand what you're
I'm
saying.
just playing it like you play a game of chess.
Right.
Like
Okay.
I know the
Understand.
rules, and let's do it that way. Let's go. Yeah. Who's talking about FinCEN here? Yeah, FinCEN is your biggest monster, not IRS. IRS is a friendly creature. Sometimes they're mean though, but all right. Let's see. All right. You guys have already very creative. All right, thanks for your comments. I appreciate that. I mean, I should probably read these comments after the call. I'm not trying to, I don't want to cause a lot of delay. That's why I don't read them. But if Mocha wants to try to read them, I mean, but no, if
Well,
there's something,
well,
yeah,
well, the PDF that you use for this, will it be available is it in the chat, or is it anywhere that we get access to it, or?
I could make it available
Okay.
with
I
my
think you can put it in the chat, and if you can put a link in the chat, we can click on the link and it'll basically download to our computer. If you wouldn't
I'll
mind,
figure out.
I got in a little bit late, and I just kind of like to follow what your thought process was as you're going through.
Yeah, without watching the videos, you could just run this through the AI if you want and do
Are
it
you
yourself.
are you a financial advisor, or are you? I came in late. I'm just curious what your
Yeah, I
background
guess
is.
you can say that. I'm an entrepreneur, but my business is a professional service where I look at people's financial exposure to certain types of risk. And
Okay,
so I look at administrative law and the legal requirements of certain things like functions of government, and
but
how
not an
people are
officer of the court,
exploited.
I'm assuming.
What's that?
Are you a lawyer? You're not a lawyer. You're not an
I'm not
officer
a
of the
bar
court.
member, so I can't represent people in the courts,
Gotcha.
which is
Okay.
not really fair.
Pro
But
se.
I can, yeah, well, I can do it in the administrative hearings, so
Gotcha.
yeah,
All
they're
right,
okay
thanks.
with that.
And you're very knowledgeable. It's been a good presentation. I
I'm
appreciate
glad
it.
you enjoyed it. Yeah, yeah. So this is, so don't be afraid of the IRS. Just understand the inner workings. Assessment is a key thing. It's your friend. It's really a thing that you want to use. So. But now I'll just leave you guys with this one thing. So I was talking to a gentleman today, and he was so fixated on the IRS and avoiding taxes on he had he was getting a rollover from a tax exempt situation, and it was going to be after tax money. So then he could do whatever he wanted with it. And I'm thinking of reallocating it. He's thinking of buying some sort of assets or something. But his total focus of the conversation was, how can I not pay federal income taxes? Well, once he gets the money out of the system, he'll have finished paying the tax on that amount of money. That's what we call after tax money. But he was focused on the wrong thing. So just keep this in mind. We say this in the investor world and entrepreneur world. Don't step over the dollars to get to the pennies. I said you need to focus on increasing your net worth. So what that involves is using the cash you have to access other capital that allows you to access assets. Don't just rely on your cash to buy assets. Use your cash to access capital that then allow you to acquire assets, and then make decisions like that on a regular basis, like once a year or something, so that your net worth goes up. Then you have a cash flow situation, and maybe you have a tax issue. Now you can dial that back and avoid the tax, legally or whatever. But in the meantime, you need more money. You need more assets. Don't be concerned about the pennies over here. Go get more money. So just leave you with the guys with that. All right. Well, thanks. I appreciate the questions, and look forward to seeing you next week.
Great
Enjoy
presentation, John.
your
Thank you.
weekend.
Yeah,
Thank you,
thank you. You
John.
too.
All right, y'all. Bye-bye.
Bye-bye.
Thank you
Ciao,
much.
ciao.